Do stock futures worsen down markets? By www.options-trading-education.com. What happened in the market? Nothing was going on, and stocks fell. Jim Cramer of Mad Money talks on the street about why stocks fall through no fault of their own. Big market sell-offs are the kinds of things that can drive investors away from the entire asset class. That's why Cramer dedicated the entire show to shed some light on the many things that impact stock prices and what really causes them to head lower. All markets go down at some point, Cramer said, and one of the biggest factors in the direction of the markets are the S&P 500 futures. Back in 1979, when Cramer first began trading, things were a lot simpler. The direction of a stock was determined 50% by the company's fundamentals and 50% by the sector it was in. But then, in the 1980s, the futures markets burst on the scene, and stocks were lumped into baskets like commodities. As the years went on, the linkage between stocks and the futures only became stronger, and in 1987, most of the market's crash could be directly tied to the futures markets, making a bad situation a lot worse than it needed to be. How is that something meant to even out the market makes down markets worse? There is unfortunately more to the story. Large equity funds take advantage of a stock's success to sell and take a profit. Because they trade in millions of shares, they tend to disrupt the market. How do stock futures work? Investopedia discusses stock futures. Futures are financial contracts obligating the buyer to purchase an asset or the seller to sell an asset, such as a physical commodity or a financial instrument, at a predetermined future date and price. The futures markets are characterized by the ability to use very high leverage relative to stock markets. Futures can be used to hedge or speculate on the price movement of the underlying asset. Futures contracts are often used to hedge risk in trading. This is very common in agricultural commodities and started with stocks in the 1980s. But futures can also be used for market speculation. Because these are essentially leveraged trades, a trader can make lots of money on a trade and can also go broke. When a trader with a large position gets caught on the wrong side of a futures trade, he or she can drag the market down with them as they sell for less and less, and buyers simply wait for the bottom to step in. This is a primary way that stock futures worsen down markets, and it does not require a bad market for this to happen. It simply requires that someone with a big trading position get over-leveraged and runs out of cash. The weight of the news. The current rally has been extended by folks' belief in Trump's promise of a brighter economic future. However, the first days of the Trump presidency have been focused on social issues and without a lot of success. The effort to repeal and replace the Affordable Care Act is likely to fail and do so very publicly. In the meantime, the head of the FBI admits to Congress that his people are investigating possible links between Trump's campaign and Russian efforts to swing the U.S. election. In the end, the weight of continual bad news outweighs the hope of a stronger economy, and down go futures and the market. For more insights and useful information about options and options trading, visit www.options-trading-education.com.